Hi, David here, founder of the Freedom Founders Mastermind community. Let's talk for a moment about market cycles. If you've been alive and in the real world for any period of time, you're aware that we always go through various business and market cycles. We go through a period of time where the markets seem to be solid for businesses and investments in the stock market, Wall Street, real estate, other asset classes. The trend is good, right? It's solid, good returns, high profitability, uh, high employment. Things are good, and then we reach a tipping point, and then the market typically cycles back down again. A recession or some kind of correction is often looked at as a time when there's a flushing out of the excesses that the up market cycle creates. Well, we've certainly seen this in the last 10, 12 years. The last downturn, the last flushing out or recession we had was the great financial recession of the 2008 to call it 2012 period. During that period of time, there was a great flushing out and a big cycle. Recession, unemployment, businesses went out of business, stock market fell, real estate assets also took some decrease in asset values. And then slowly but surely, we started on an upward trend. There's lots of things that fueled the last 10 to 12 years. I'm not going to go into those in this short video here today, but there are a lot of things that fueled what we have experienced. And a lot of people, I think, unfortunately, falsely believe that whatever gains that they've had in business or their wealth production, their assets, investment assets, whether they're on the stock market side or real estate or other businesses, a lot of people unfortunately believe that it was all their own doing. And no doubt about it. You have to do something to start the wheel turning. But to a great extent, a lot of the wins are because of the market, not what an individual did. People who have only really seen one side of the market, and that's usually an upside, they think that this will go on forever. They think that, well, that they are immune to anything going wrong because their fingers or hands are made of gold, and anything they seem to touch does well. We've seen that in the dental industry, where the practice models that have been created. There's private equity and DSO groups that are have paid larger multiples for those practices. We've seen the stock market have great wins over the last 10, 12 years. We've seen the real estate side, something I'm obviously very well versed in, also have the same thing. These are bubbles. These are bubbles, and eventually bubbles pop. How you navigate the bubbles is really what's going to set you apart, or let you still continue to be, quote, successful without taking that deep dive, that big hit that sets so many people back by 6, 7, 8, 9, 10 years. Because to recover from a big hit where you lose businesses or assets, or you have to dip into savings or 401ks to save the day, that's a massive hit. Stock market values typically go down 40, 50% in these big corrections. And yes, do they eventually cycle back up? That's what a cycle is. But the problem is, how much time do you have to allow for the cycle to come bring you back up again, to at least even break even? When you take a 50% loss in an asset class of any kind, you've got to have a 100% increase in the valuation to bring you back even to even. And that takes a number of years. Now, if you're young in life and you're in your 30s, maybe your 40s, you can withstand some of that because you're still going to be productive, ideally, for probably another 15, 20, maybe 25 years. And so you can catch up. It's not something you want to program yourself to have to do on a regular basis, but when you're younger, you can absorb some of those downturns if you weren't savvy enough, didn't have enough experience to know how to navigate the corrections. If you're older in life, if you're in your 50s, late 50s, 60s, you really don't want to have to do a restart, a reboot, and have to rebuild half of your assets just at a point in time when you were thinking maybe the grass is greener when I can start to take my foot off the pedal. Not a great time. And that happens over and over again in every cycle. My age, I can tell you, I've been through a number of these cycles, and I've watched, as a younger person, I've watched dentists older than me who would retire out at the top of a market thinking all was good. And then within a year, 18 months, markets go into a big correction and they're back looking for a job again, or maybe have to restart their practice again. Not a good look. So understanding that we go through full cycles, we have to understand how to be a full cycle entrepreneur, business owner, and investor. And most people, if you're under 45 years old, you probably haven't gone through a full cycle. I'm not saying that you're not smart. You are smart and intelligent to do what you've done, but do you understand what a full cycle looks like? And if you haven't gone through it, you really don't. What I see a lot today I see a lot from my dental colleagues of people who have ridden this up market. Maybe they've made a lot of money in stocks, certain stocks in their 401ks have looked good on paper. People throw money into crypto. I'm not going to judge that right now. Again, but just thinking that's the holy grail. We've seen since the first of this year, we've seen as we head into a recession, a correction, inflation coming on, the Fed having to attack this. It's a different time right now, and we are definitely going into a correction. I think we're going to a relatively deep correction. I think we could see something back like we had in 2008. That's not going to be pretty for a lot of people. Understanding how to protect your downside risk, both in business and in your investment categories, is so important. And most people don't know. They just been throwing money out there and thinking it was all them, and they can just keep making money hand over fist. I know some young docs who are very propitious in being on their frontier, and I love that, building their practice model and then putting money into things that have worked so far for them. There's people out there in dentistry who have really got out and bought a lot of rental properties. And, you know, I understand that. I did the same thing when I was younger. That's how I got started, was buying assets, real assets that would over time pay down the debt and produce, you know, the passive income that I didn't have to work for. That's a good thing. But I see some that are so exuberant that they've taken the, I say, false equity, meaning the market created the equity, not them. The market created some amazing equity in the real estate markets in the last 2 years, all the stimulus money. And so they bought houses 3 or 4 years ago, worked hard to manage them and fix them up. I grant them that. That's just putting your nose to the grindstone. But then these equities kind of blew up over the last year or two. And so now they've got all this equity. And I see some of them going out and saying, hey, I'm able to refinance, pull out that equity, tax-free. Well, it's not really tax-free. It's tax-deferred. You always got to pay the piper, but they call it tax-free. Surprise will come down the road. But the biggest problem I see is pulling this equity out that I don't think really has a real basis. I mean, some of it does, but most of it was just built up over the financialization of the markets by the Fed and the cheap interest rates. These young people don't understand that. They think this is how it is. The world's made on you build assets and you suck the equity back out tax-free, and you've got all this extra money. You can spend some of it and live off of it. You can elevate your lifestyle. If you're really smart, you go out and put in other investments, but you're investing off of debt now. Debt is an important part of growing wealth, but to be that irrationally exuberant about the debt that you can pull out when the money's cheap, hot, credit's wide open, I think it's a big mistake because they haven't seen the other side of the coin. And I'm just warning people to be careful, to understand how to go through the correction and navigate the uncharted waters that many have never seen. Is going to be an unpleasant story for many of them. They'll survive, but it's not going to be pretty. It could end up in divorces and things falling apart, and I hate to see that. So again, my advice is just understand with what you have today, yes, you've worked hard for it. Be careful with how you put it out in the marketplace, thinking that anything you've done so far to be, quote, successful in that regard, some of it has to do with you, but a lot of it has to do with the market and a lot of the false pretenses that allowed the markets to go up. We're in a correction now, and if you can weather this storm without major disruption, you'll do fine. If the apple cart gets upset, depending upon where you are in your life, your career, your age, is going to have a lot to do with how you finish out over your career and the end of life years that you have. Be very, very careful is my point.